All right, let's talk about getting started with investing. We're going to do things a little differently today. Instead of a boring to-do list, we're going to look at the most common mistakes people make, and we're going to turn them into a clear, practical roadmap for success, all based on what real investors have learned, often the hard way.
Let's just kick things off with this confession from a Redditor, Myra_Sohi, because I think we've all been there. They basically said, when I started, I thought I was a genius. Turned out I was just making all the classic mistakes. And that's the perfect place to start, right? It's a great reminder that it's okay to stumble a bit when you're learning something new.
So, here's what we're going to cover. First, we'll nail down the 8 common traps that get most people. Then, we'll talk about building the right mindset to avoid them. After that, we'll look at the actual tools you can use, dig into the hidden cost of fees, and trust me, this is a big one. And finally, we'll wrap it all up with a simple game plan to get you started.
All right, let's get into it. Section 1. The 8 common traps. These are the classic mistakes that time and time again end up costing beginners not just money, but a whole lot of peace of mind.
Okay, so here they are, the beginner's blunders. First up, buying hype stocks. Jumping on something just because everyone's talking about it. Then there's putting all your money into just 1 or 2 companies. Big mistake. Trying to time the market. Getting in at the perfect bottom and out at the perfect top, that's basically gambling. And then we have some really practical ones, like not having an emergency fund, which can force you to sell your investments at the worst possible time. Of course, there's overtrading, which just makes your broker rich, and a personal favorite, trusting some random tip you saw online without doing any research. And finally, maybe the biggest mistake of all, just delaying and never starting a regular plan. Each one of these is a tough lesson for someone out there.
And this comment from another Redditor, Longface7086, it hits the nail on the head. It's all part of learning, for sure. But the real key is focusing on steady habits over quick wins. Thinking of it as a marathon, not a sprint, that's the perfect mindset to have as we shift from the problems to the solutions.
So let's do that. Section 2. Your investor's mindset. This is all about building the foundation, because if you get these core ideas right, you'll naturally avoid most of those traps we just talked about.
The first big pillar is something called asset allocation. Now, before you even think about picking a single stock, you got to think about the big picture. What's your mix? How much of your money is in growth-focused things like stocks versus more stable stuff like bonds or even cash? There's no single right answer here. It all depends on you, your goals, and frankly, how much risk you can take without losing sleep at night.
And that big picture mix leads us directly to the magic of diversification. This is your #1 defense against the mistake of betting the farm on just 1 or 2 companies. You've heard it a million times, but it's true. Don't put all your eggs in one basket. And to make this super clear, check out this brilliant analogy from investor.gov. Imagine a street vendor who sells both umbrellas and sunglasses. If it rains, they sell umbrellas. If it's sunny, they sell sunglasses. By having both, they've made it much less likely that they'll have a terrible day. Your investment portfolio should work exactly the same way. You want some things that do well when other things are down.
So it all comes down to understanding this fundamental trade-off. It's pretty simple, really. Stocks, on one end, have the highest potential to grow your money, but they also come with the highest risk, especially in the short term. Cash, on the other end, is super safe, but inflation will slowly eat away at its value. Bonds are usually somewhere in the middle. Your personal asset allocation is just you deciding where on this spectrum you're comfortable being.
Okay, so the mindset is there. Now for the practical part. Section 3. Choosing your tools. How do you actually do all this stuff? Asset allocation, diversification, without needing to be a Wall Street wizard buying hundreds of different things?
Well, for a lot of people, the answer is a mutual fund. Think of it as teamwork for your money. A fund pools cash from thousands of investors, and then a professional manager uses that giant pool to buy a whole bunch of different stocks or bonds. It's like instant diversification in one simple package.
But, and this is a really big but, not all funds are created equal. You've got 2 main styles. On one side, there's active management. This is where a fund manager is actively trying to be a hero, picking stocks to beat the market. That takes a lot of work, which means you pay higher fees. On the other side, you have passive management, like an index fund. These funds don't try to be heroes. They just aim to match the market by buying all the stocks in an index, like the Nifty 50. It's simple, it's automated, and most importantly, it means much, much lower fees.
And that word, fees, brings us to what might just be the most important part of this whole conversation. Section 4, the hidden cost of fees. Because sometimes the money you don't lose is more important than the money you earn. The key number you got to look for is the expense ratio. It sounds small, it's just a tiny percentage, but it's a fee that gets taken out of your investment every single year. It pays for the manager, the paperwork, the whole shebang. And here's the secret. A low expense ratio is one of the best predictors of a fund's future success.
And this is why it's a huge deal. Just look at this chart. We've got two people, they both invest 10 grand, and they both earn a solid 10% a year for 20 years. The only difference is the fee. The person paying a 1% fee has their final amount get eaten away. The other person with a tiny 0.05% fee, well, their final value is way, way higher. That difference is just staggering. That is the destructive power of fees compounding over time, and it's why so many smart investors swear by low-cost index funds.
Okay, we've covered the mistakes, the right mindset, the tools, and the hidden costs. Let's bring it all home. Section 5, building your simple game plan. Let's turn all this knowledge into something you can actually do.
You know, the best plan is usually a simple one. Here it is boiled down into 4 steps. Number 1, start a systematic investment plan, or SIP. Just invest the same amount on a regular schedule. It's automatic and it stops you from trying to time the market. 2, choose low-cost index funds. You get that instant diversification without getting killed by fees. 3, and this is so important, focus on your career. The best way to have more money to invest is to earn more money. And finally, number 4, stay consistent for the long term. Don't panic and sell. Just let time and compounding do their amazing work for you.
And that brings us to the final and maybe most important idea. After learning about all the ways you could mess up, the single biggest mistake is letting the fear of messing up stop you from ever starting. The path is clear. Consistent, long-term, low-cost investing works. So the real question isn't how to be perfect. The question is right there on the screen. What will be your first move?